Michael, it's a real pleasure to be with you today, and thank you all for joining us. I am Mark Walter. I'm a partner at Associates. We provide investor relations and capital markets communications for pre-IPO companies and GPs. So it's a real pleasure to be speaking to you today, Flashpoint Venture Capital. Now, I have known Flashpoint Venture Capital for quite some time, and I've been very, very impressed with your recent growth. Michael, in difficult markets, you are now at around $500 million in equities under management.
That's correct. First of all, thank you for having me. My name is Michael Szalontay. I am one of the co-founders of Flashpoint and also the managing partner of our direct secondary strategy at the moment. And you're right, we have been able to expand the firm. I think we made a very smart decision back in 2019. Back then, we were only a venture capital organization, but we decided to essentially turn ourselves into a platform. And we've added two more products, being venture debt and direct secondary, in 2020 and 21. And that has helped us to fuel growth, but also principally to be able to better service our clients, the founders of tech companies. And that is very important. And, definitely they live now in a very interesting time.
They certainly do. And that has impacted on the products that you're offering and the value add that you provide. So we will today go through some of the external factors and challenges and opportunities that you're seeing. So we will gaze around the world and gaze around the sort of areas that you're seeing traction. On that, what currently, from a very top-down view, what currently inspires or worries you most about the venture market presently?
Excellent question. I have to say that, to me, the most interesting trend happening at the moment is that the tech market has obviously grown tremendously. I've read somewhere that the total market capitalization of all of the unicorns globally is about $5 to $6 trillion. And then, okay, if you add the smaller companies, the ponies and whatever, you might get to $7-8 billion. At the same time, if you look at exits, so liquidity that is generated in this market through either mergers and acquisitions, right? So sales of companies essentially, or IPOs, it has only been $400 billion in 2024. So that's about 5, 6, 7 maybe % of total. Clearly not enough. So that means that if you're today holding, paper in a private tech company, you have to be ready to be locked up for a very, very long time. This is a very interesting market inefficiency. It's partially as a result of the explosive growth of sort of tech as a sector in general, and the valuations of these companies, growing. It's also, to a degree, a result of sort of a structural shift in the markets. Companies stay private for longer. We will talk about this. But as a result, it means that there is less liquidity. So I view this inspiring because it creates opportunity. It creates opportunity for firms like mine in order to operate in a very inefficient market, try to make it more efficient and make money along the way. But it's also challenging, right? If you invest in these markets, it's challenging for GPs because ultimately the sole purpose of existence for GPs is to generate liquidity to their LPs, right? And as we've just discussed, if you look at the numbers, the ability of people to generate liquidity is definitely compromised.
Yeah, we'll touch on some of those areas. But what's also very interesting is, we are in apparently a post-globalization world, right? But nevertheless, the US remains very, very important. I saw a statistic recently that was very interesting, I thought, from the Draghi report of European competitiveness, that only 4 of 50 the largest tech companies in the world are European. I mean, as a business, are you focused geographically, or are you focused more on people? How do you see this?
We're definitely focused more on people, and as you've rightly said, the world has become a very, very global place. We like to phrase it in the following way, that we're supporting global tech companies, which means that primarily we're supporting US tech companies. And then if you make the next step, then we have to say that we're supporting immigrant founders to the US. And our specific, unique focus is on founders who come either from Central Eastern Europe or from Israel, in some cases sort of more broadly from the Middle East. And, interestingly, I'd say 80% of the revenues of the companies that we support ends up coming from the US. But most of the time, the R&D teams, the tech people, the product people, the customer support people sit in low-cost economies. And we really like this business model because there is an inherent sort of what we like to call efficiency edge. Essentially, you're supporting a low-cost labor market, exporting a technology or a product that it creates to a high-priced market. And, if you think about it, for any tech or venture capital investor, most of your money is spent either on salaries or sort of sales and marketing, but even the sales and marketing spend is to a degree salaries, right? So if you can spend the money that is going into salaries efficiently, that's a very, very big plus for you as an investor. And if you think about Central Eastern Europe, Israel, these countries have very high levels of university education, very talented people. And at the same time, especially if you think about Central and Eastern Europe, you have people who haven't had access to the global capitalist free world until 1990, right? So these people are also very hungry. Forgive me the pun as a Hungarian. And, the last point that you could make here, I suppose, is that also all of these countries are Western democracies, right? Most of them are part of the EU. Even Armenia, which is probably sort of the easternmost market that we cover, is actually quite a vibrant democracy. Definitely Israel is clearly a Western democracy. So culturally, there is an easier affinity for the entrepreneurs in these markets to make the transition into the US and build successful US businesses.
And look, unfortunately for founders in these territories, over the years, they've had to probably operate on a shoestring, quite frankly. So in terms of operational leverage and in terms of really driving out efficiencies, presumably they're going to be far ahead of the norm. They will be making more with less. Is this something that you're seeing?
Very true. I mean, we've looked at the statistics of companies reaching unicorn status. And the main question is, how much investor capital have you raised to reach this status, right? And so if you look at companies where the founders have come from Central and Eastern Europe or Israel versus companies where, they're completely US founders and US companies from day one, this efficiency edge is basically a 40% differential. So companies that originate in the CE or Israel reach unicorn status having spent 40% less money. And it's not surprising, having discussed, the underlying reasons for it just now. It's not surprising at all.
No. And they have a very different customer base as well, with different budgets. So, I think extracting these efficiencies is high priority. I'm doing a lot of work currently in the Adria region as well, Croatia, and it's tremendous the amount of activity that you're seeing. I think the one area that is disappointing is for Europeans at least, is the regulatory backdrop just seems more challenging, and it seems more challenging to obtain institutional investment in Europe as well. So I think this globalized view that you have does resonate. I'm seeing founders and investors come together to identify ways of addressing these inefficiencies in the marketplace. There was a Future 500 forum I recently saw in Bled as an example. But investors and investees are having to come together to do that, which is unfortunate. But hopefully, it'll trigger a wave of dynamism in the region. So, Michael, if you were to go back to the beginning, let's say 10, 12, 15 years ago, with Flashpoint, what would you be saying to yourself then? What sage of wisdom would you give yourself?
I think that the main learning is that this is a very long business. It's a patient business, right? Whenever you launch a fund, you're basically launching it usually for 8 to 10 years. And as an investor and also as someone who worked in investment banking before Flashpoint, which often is closer to the public markets, in the public markets, people do have this sort of recency bias, right? They're more affected by what's going on in the market today. Whereas really, and obviously by the cycle as well, probably the overall economic cycle. Whereas in my current line of work, you basically just have to be patient, do good work, and if you support the right companies, they will grow and they will win, notwithstanding what's happening with the cycle, and you will end up making very good money. So I think patience is probably number one. And then, because we have 3 products and they are quite distinct in terms of both the risk reward that the investment strategy targets and that we offer to our LPs in these products. As a result, the learnings for these 3 products have also been very, very different. I'll give you 2 simple examples. On the venture growth side, where we support companies where revenues are 1 to 5, so basically Series A companies, still smaller companies that have a proven product market fit, but that are looking to scale aggressively. Probably the most important lesson is that you have to get into more great companies, right? So you have to sort of miss less. The price of missing is quite big. And it's okay to make mistakes. You will make mistakes. So you have to find the right level of risk-taking, right, where you are taking risks, but your main objective is to catch great companies. If you look on the direct secondary side, the main adage is almost the opposite. Your main objective is to avoid making mistakes, right? So even if a company will not do great, even if it will just do good, that's okay. The return target that you have is lower, so you just have to target solid companies, and the entry price as a result becomes very, very important, right? You have to essentially buy cheap so that even if things don't go as planned, you still don't lose money. So the learnings are very different. One theme which we employ across all of our products is that we try to overweight follow-on investing. Because obviously we operate in the private markets, and the best kind of trading, I suppose, is insider trading. And in the private markets, it's allowed, right? It's completely legal. And definitely when you write the first check to the company, even if you study this company for quite some time and monitor it, observe it, diligence it, there's still a significant information asymmetry between you as the investor and the founders, the people who are running it, the people who are sitting in a constant flow of information about the company, right? But once you're in, especially if you're in the board or if you get broad information rights, 6, 9, 12 months later, a significant chunk of this information asymmetry is essentially removed. So then if it is a great company, that's the time to put all of your chips on the table and aggressively go after this company, essentially. And so this has been a big learning for us in general over the years, that the best risk reward is on follow-on transactions. And so you want to put most of your capital into follow-on transactions, right? So we try to avoid writing very big first checks in all of our products. And very often the deals that we agree with people are tranche deals or options, right? So a deal where there is a first step and maybe there is an option which is more expensive than the original deal, but it's fine because the risk, even if the option is, let's say, 50% more expensive in terms of price, the risk decreases not 2x, but 5x or 10x. So the risk reward becomes inherently more attractive.
Yeah. And of course, in the interest of attracting additional capital providers, particularly for any sort of follow-on offer, exits, etc., it's important to be communicating, right? As a company, it's important to evidence the track record that you're building as a company, your success, both from a consumer or client's perspective, as much as it is for future sort of capital market progression.
That's an interesting point, actually, because I believe that this is one particular area where there is a huge difference between Israel and CE, which are sort of two big markets that we cover, right? So the Israelis are much more aggressive in marketing themselves. They're much more loud, and the CE people are often quite shy. And, if you think about an old marketplace, right, like a souk where people are selling, their trade, the fruits and vegetables, right? Who sells more? Yeah. The guys who are loud. So definitely, you need to be out there. And this is actually one of the services that we provide to the companies that we support, that we include them in our portfolio tracker, which we distribute among all of the major players, US and European players who come at a later stage. So we try to constantly raise the awareness in the investment community of who are the companies that we support. And which one of those companies are doing great.
And it's getting the balance right, isn't it, between, as an issuer, doing what it says on the tin, as a GP, also the same, that you're delivering returns, not overinflating expectations, but at least evidencing progress on specific goals. And so this is the constant tension that I see with companies I help with their communications, that in terms of making medium long-term projections on growth, there is, in these markets in particular, a lot of concern with doing that. So it's a very unusual market to be out there marketing your ware.
Yes and no. Having observed this market from 2011 onwards, I think that the amount of companies that come out with wild forecasts and then spectacularly fail has not changed. And so, but again, coming back to the idea of follow-ons and information asymmetry, this is one element of the asymmetry which gets removed with patience, right? So you monitor a company for a year or two, they made some promises 2 years ago, 1 year ago, and then you've seen them actually deliver on these promises. Okay, then you understand that these are serious people who, know what they're doing. And this information in itself is incredibly important for an investor.
Yeah, it's track record. We're seeing the same in public markets, where there are more leanings and tendencies towards far less short-termism, whether it's corporate reporting and moving away from quarterly to semi-annual, etc. So this is a trend for sure. Okay, we're still speaking rather generally, but if you had to describe the venture market currently in one word, what would that be?
I don't actually have a word for you, but I do have a phrase for you, and it goes as follows. AI is eating the world. Okay, and it was, interestingly, originally, the catchphrase was software is eating the world, which I think was formulated by Andreessen back in sort of 2011, maybe. And definitely he proved to be right, because from then on, vertical software, became a huge success. B2B software took off. And now we see a huge wave, a new technology, Another way to sort of try to put this in perspective is, if you remember, we had sort of Web 1.0, which was sort of the static internet, right? Then we had Web 2.0, which was the more interactive internet. And then the idea about Web 3.0 was that it's going to be blockchain. But actually, Web 3.0 ended up being the cloud. So things moved into the cloud. Things became much more distributed, as opposed to being, held on premise or on your computer. So software essentially became, ethereal. Now what we're seeing is Web 4.0, which is AI appearing and significantly changing the landscape and significantly increasing the productivity that software is able to deliver. Before, when software appeared, everyone understood that it's a useful tool and that, it will help people be much, much more productive. Now, the big fear that people have with AI is that it's just going to take over jobs, right? That essentially we will not need people anymore. And while I personally do not subscribe to this premise at all, I do understand why people are fearful, and we have to view this revolution as a Web 4.0. And I think that, this phrase that AI is eating the world is something that we're going to see play out in the next 5 to 7 years.
On your desk, when you're looking at when you're screening and looking at opportunities, are you seeing inflated valuations? Do you think maybe then, in other words, are considered is repricing currently? Where do you think we are with that?
Look, it's not the first time that there is a significant amount of hype around a certain technology, right? We had the same around blockchain, maybe 6, 7, 8 years ago. Definitely, AI is hype now. Companies that have real AI behind them and that have traction get or manage to raise money at very, very high multiples. But most of these companies are still early stage, right? So you don't really have many AI companies that have, let's say, 100 million of annual revenues, right? It's mostly still smaller companies. This will change very quickly. But also, for us, it means that AI dominates the discussion for our venture growth business, but it's less relevant, at least as of now, for our venture debt and sort of direct secondary businesses.
Yeah, interesting. So if you were a private investor today with, say, $1 to $5 million in capital, how would you look to allocate the venture portion of that portfolio then?
Well, first of all, the old adage is that you have to diversify, right? That's the best advice that I think has ever been given to investors. So I think that it's certainly true that I wouldn't recommend anyone to do direct investing. Because by direct investing, essentially you take idiosyncratic risk on certain names and people. And unless it's your profession, unless you do this and you're really an expert at this, it's very hard to do that. And even we, who have this as a profession, we build portfolios of companies. So we still try to diversify, right? And we're incredibly selective. So over the years at Flashpoint, we've probably supported 80 companies. And I think that we look at 200, 250 companies to make one investment, right? Yeah. So, if you don't want to do this as a full-time job, then my recommendation is that you go to the professionals, you essentially invest into funds, and you diversify. You select a couple of managers that you like, where you have a good relationship, where you understand what is their alpha, what is their unique source that drives returns. You understand that they're able to generate consistent returns. And I wouldn't go for outsized returns because it's also driven by vintages and driven by economic cycles, right? So consistency of returns is more important than sort of the return on the last fund. And probably the last advice is going to be one that you will not like, but it's more situational with where the macro economy is now with the high interest rates. Probably the bit that I wouldn't do at the moment is pre-IPO stuff, because interest rates are quite high, and it can really go two directions from here, right? One is that interest rates will be cut in the next 2 years. And then, the economy will thrive, and there will be more money in the economy and valuations will go up and there will be more valuations. That is certainly a scenario that could play out. But there's also a different scenario where, interest rates stay high, and there is a significant economic downturn. And I think that at the moment, also with the geopolitical instability, and with the tariffs adding additional unpredictability to the markets globally, I think pre-IPO is a very risky proposition.
So we've got 3 words right there, haven't we? We've got patient capital. We have got diversification. And I guess you were talking about, we've touched upon venture debt. So I guess we have to be nimble as well and change with a really rapidly changing environment. So on that, as a follow-on, secondary deals are getting a lot more attention, it feels like. How do you see this market evolving and what its potential is then if ultimately down the chain, the end game is public markets most of the time. But if that's not a route, then what happens?
Yeah, we should start the answer to this question by saying that it used to be true that the end game is the public markets, but it's not true anymore. So just to give you some statistics, which for me are mind-blowing. So in the year 2000, there were 370 exits in the tech sphere. And 62% of those exits were M&A, and 38% of those exits were IPO. In the year 2024, the overall amount of exits went up significantly to I think 1,200. However, the amount of IPOs is down to 3% of total. Just 3, Mark.
It's remarkable.
In the 80s, the median age of a company that was doing its initial public offering was 6 years. Today, it's 11, 12. Yeah. And we've talked at the very beginning about sort of the overall low turnover in the tech market of being, 5 to 7% maybe. And my conclusion from all of this is that it's much more likely that your company will be bought and sold than you going public. And that's okay. But also, the market has to develop other ways, other solutions of liquidity. And when we talk about secondaries, we need to make a very clear distinction in the very beginning by saying that there are direct secondaries, when you buy stakes in companies and end up on the cap tables of companies, providing liquidity to the shareholders of these companies and helping to sort of clean up and consolidate the cap tables of these companies. And that's one instrument, and that's the instrument that we do at Flashpoint. And then there is a completely different brand of secondaries, which is what people usually mean actually by secondaries, which is buying into funds. So basically buying out LPs. And that's also a big market. It's also an interesting market. Obviously, in that market, you're still a step removed from the actual liquidity. This is why we don't do it, because we believe that you need to be as close to the source as possible. And it's more interesting to be close to the source. And for our skill set, sort of, it's more relevant to a degree to be close to the source, because our original DNA is being investment bankers and private equity professionals. So we know how to deal with companies. But both markets are very interesting. I think that both of these instruments are going through huge growth. So back when we started 5 years ago, there were, I don't know, a handful of players globally doing direct secondary. Right now, there are like direct secondary funds launched every other week. Equally, there are some other products out there. I'll mention just a few which I believe are interesting and that could also provide additional liquidity in the tech market. One is NAV lending. So basically, people pledging the stake that they own in a tech company and generating some liquidity for themselves. I think that's an excellent business. I really do like it. And I think that that's going to grow significantly in the next few years. And then the last one is what's called sort of sometimes it's called GP restructuring, but essentially it provides an opportunity for a GP to take a fund and close it down without actually selling the companies one by one, but by selling the whole portfolio through rolling it into a new fund that they will also lead. And this is sort of a trick to a degree because essentially you extend the fund life. Let's say your original fund was 10 years and now it's over, and you understand that these companies still have years to go until any liquidity is going to happen in them, right? So instead of trying to get 1 or 2 extensions for a year, which are not going to save you in this situation, you sort of go through this restructuring rollover, but it does provide liquidity to the LPs, right? Because new LPs come into the new fund, and so the LPs from the old fund who just want to exit and who do not want to subscribe to a further investment horizon, they have the opportunity to exit. So we see more and more of these solutions in the market, and I think it's incredibly important to keep the market healthy. However, having said all of the above, I still believe that the biggest issue for venture capital and for GPs is the lack of liquidity, not enough focus on exits. And you sort of understand why. People were so focused on making good investments. And there was this saying that circulated in among VCs that, if the company is great, the exit will look after itself. Well, guess what? It's not true. So I think the right mindset is to think about exit day one, a little bit akin to private equity. And you just have to be very focused on making sure that you return money to your LPs. And what we've seen in the last few years is, funds that are driving DPI are much more popular and successful with investors than funds who on paper have great returns but are not driving liquidity back to their investors.
It's been a phenomenal time. I mean, I suppose these structures are really for the sort of pre-COVID 2019, 2021 cohorts that have been sitting on portfolios for a long time. They have been stress tested like no one else will ever have been, have proven themselves to be very, very valuable and are still in growth phase, right? So, venture, I mean, what's your view on this? Venture used to be the era of scaling. Now it's more about demonstrating efficiency, resilience, and showing that you can operate in virtually any environment.
I think it depends on the stage in which you are, right? So if you're Series A, it's still all about scaling. I think you are right that in general we've seen the world speed up. There is this lovely book which I recommend to everyone to read called Stolen Focus, which is full of little tidbits of wisdom about how technology and internet has changed the world. One thing which blew my mind is that apparently someone measured how people walk on the streets of New York and London, and we are walking 10 to 15% faster on the street today than sort of 30, 40 years ago, right? I mean, that's crazy, but it shows that everything has sped up. And of course, technology change, as we know, sort of is a geometric progression. It's sort of a runaway train. And so it does mean that founders need to be more agile these days. For example, if AI today, whether you're a small, a medium, or a large company, if you know AI is not part of your product and strategic roadmap, you're dead. However, at the small, early stage, sort of small scale companies, it's still all about scaling. You basically want to get into businesses which are capable to grow their revenues 10, 20, 50, 100 times, right? And if you look at our most successful investments, they're all companies that have scaled massively. I think where you're right that efficiency is now also an important part of the conversation is sort of the mid stage. So whenever companies reach 20, 30, 50 million revenues, you want them to be what's called rule of 40, which means that you take their revenue growth and you add their EBITDA margin. So a company which grows 40% a year and is break even is a rule of 40 company. Equally, a company that grows 50% a year and is minus 10 is also a rule of 40 company, right? But let's say in 2021, companies growing 80% and having, I don't know, minus 80% margin were attractive, right? Even though it's a rule of zero company. Now, okay, if it's a sort of startup, it might get financed if it's a seed company or a Series A company. But if it's at a later stage, there's no way this company gets financed, right? So people are putting more emphasis on efficiency. People do ask the question, can this business turn break even? It is now a more important question. And in some ways, you have to think about the world in simple terms. And the most simple way to put it is that when interest rates are high, valuations are low. There is a direct relationship between these two things, right? So if you can't turn break even, it means you need to raise money. And if you need to raise money soon and you need to raise money in this environment of high interest rates, it means you're going to get diluted significantly by a low valuation. So people understand this and investors understand this. So they don't want to support companies that will have to keep raising money. That's what's changed. That's what's really changed.
It used to be all about revenue, and now it's about productivity, efficiency, and showing a pathway to profitability. I mean, how much time would you typically give, I guess it's case by case, but a company to evidence profitability?
Again, it depends which product we're talking about, right? But on venture debt, I would say that it's usually venture debt is provided on top of an equity fundraising that the company has completed concurrently with a venture debt financing or just before sort of a venture debt round. And post venture debt, we want these companies to have 18 months runway. On direct secondary, to a degree, we're even more aggressive. We want to make sure that these companies can basically turn break even with the cash that they have. So for me, if I understand that this company needs to fundraise soon, I'm not going to invest into it from my direct secondary business.
So when you're screening, they will need to have evidenced this pathway before you buy.
Correct. I mean, in simple terms, they just need to have cash on the balance sheet, right? And they need to have, let's say, 18 to 24 months runway, but also a clear trend of burn decreasing, so that, I understand that within, the 18, 24 months runway that they have, they will be able to close this gap to zero and turn break even. Even better if they're profitable.
We're still talking generally. We have some specifics to go into, and we have not much time left. But I do want to ask you, in your view, is there anything that founders are lacking today? What do you think has emerged coming out of the last few years? What are you seeing?
I remember that even when we started looking sort of broadly at companies back in 2011, 2012, founders used to be younger. So, you would routinely see these guys in their mid-20s, late 20s, right? Now, most of the guys are in their mid-30s, early 40s. And why did this happen? I think that success has brought more people in. It's now a less risky proposition than it used to be 20 years ago to say to your wife or husband or partner that, okay, I want to be a tech entrepreneur. I'm now starting a company, right? 20 years ago, people would have thought you're crazy because obviously chances of success are low, right? But people realize that it's also a lifestyle. You found a company, you raise some money. Even if it's not successful, you still make some money through your salaries and so on and so forth, right? And a lot of people just adopted this lifestyle and became serial entrepreneurs. So, and for us, having mature founders, more founders who have more life experience is definitely good. So that's a positive change. The flip side is that I believe that the market used to be pretty empty. Especially looking back, you could take spaces and market niches where no one was doing it. And you basically had to take a completely offline niche and you had to digitize it. Now everything is online. Software did eat the world. So there isn't a niche anymore that needs to be digitized. It's no longer a penetration play. Remember when cell phones appeared, right? And sort of the mobile operators were playing for penetration. They wanted to give every person on planet Earth, a cell phone. Then we wanted to give internet to every person. Then we wanted to give software to every person. Every person has software now. Every business uses software now, right? So it's no longer about that. It's now more difficult to come up with great ideas. And I believe that's the big challenge of today's world.
You're not short of choice, clearly. And you have to really differentiate very strictly between... It's very competitive, essentially.
Very competitive.
Yeah. So, okay. Let's move on then to... If we talk about the Flashpoint Fund 2 as an example, and the secondaries... why did Flashpoint decide to launch a secondary product? What's the main purpose of this fund?
So, as discussed right at the beginning, we saw this opportunity in the market of sort of not having enough turnover for mid-stage and sort of later stage technology companies. It's a very inefficient and untransparent market. And we thought, okay, we can do something that would be part of the solution, right? And the founders in a mid-stage company have many problems. Obviously, their focus remains on building shareholder value, right? They just need to build a great business. They might have, at that point, hundreds of shareholders, and these shareholders are quite misaligned. Some of them are employees or even ex-employees. Some of them are ex-founders. They're themselves shareholders. Then you have the angel investors. Then you have the early-stage investors. You have the late-stage investors, right? You have this compote, soup of sort of people who have different maturity horizons, different price expectations, different liquidity needs. So what starts happening? The founders face two big problems. The first one is that every month, every 3 months, there's some people from the cap table who come to the founder and tell him, look, I want to exit. They basically start bitching. When the founder's main job is to build shareholder value, right? And the company's not raising now, so he needs to waste time to solve someone else's problem.
Yeah.
Or he can indulge these people and help them, but, or he can sort of piss them off, which is also not great, right? So you're like, no solution is great. So our offering is to the founders, first and foremost. We still view them as our main clients. And my offer to them is simple. I'm here to make their life easier, right? And the way we do that, and the standing offer that I have to any founder of a mid or late stage tech company, give me your information and I will formulate the price.
Right.
So that when these people come, at least you can tell them, look, if you want to sell, here's a price. Yeah, you might not like it, but it's then not different to a public market. Right? In the public markets, there is a price at any moment in time. Okay, if you don't like it, you don't sell, right? But I solved this problem for him. The other thing which is important is that founders obviously have to keep their personnel and employees motivated, and options and the shares that these employees hold become a significant part of this motivation scheme as companies become more successful. So giving employees an opportunity to enjoy some of the fruits of the labor, if it's not too much, actually makes them more motivated. We've seen a similar trend with founders, and I've mentioned to you that founders are now a little bit older. So, imagine this guy who is 35 or 40, right? He's just had some kids. He runs a very successful tech company where the revenues are 50 to 100 million. Okay, he makes a nice salary. He owns a large stake, so on paper, he's super wealthy. But he's never actually got any money out of his company, right? So my view is that, let him sell $1 million, $2 million, of course not 10 or 20 or 30, which will change his perspective. But what will happen? Okay, he'll buy a nicer apartment. He'll buy a good car for his wife, and as we know, happy wife, happy life. So he will definitely be more motivated. And, especially when you have kids, you need to provide for them, right? So giving him the ability to do that in a better way would make him even more hungry. So it's all about striking this balance, but it's definitely very important to give this opportunity to employees. And we've done a number of deals in our first direct secondary fund, both just buying from employees, but also another interesting problem is that in some countries, when you have options, you need to sort of vest. When they vest, you essentially need to pay the strike price. So you actually need cash to do that. So what we've also seen people being forced to do is essentially sell some of these options to create the cash so that they can actually transform these options into shares. And then a third problem that we've seen is that in some countries, you have to pay taxes on the mark-to-market of these options. So your company goes up, you haven't made any cash, but the value of your options is now much higher, right? And suddenly you have to pay the taxman. So you need to generate some liquidity to keep it going. So we solve all of these problems for the founder and his employees. And I think it's a very useful tool. And definitely now there are more players, but also a bigger understanding among founders that these tools do exist.
And how are you looking at valuations right now? Has it evolved? I mean, is it a multiple of earnings? How are you seeing this play out right now?
If you think about the public markets in the space, right, and the big software businesses, there is the Bessemer sort of index, and then there's the Meritech index. So these two indexes are like the most important in terms of looking at public valuations, and both of these indexes are highly correlated to what's called the rule of 2x. Basically, if you remember the rule of 40, which is revenue growth plus EBITDA, the rule of 2x is 2 times revenue growth plus EBITDA. And this metric has a very high level of correlation to the multiple, to the revenue multiple on which you trade. So what does this mean? First of all, it means that revenue growth is still valued by public markets about 2 times more than profitability. Right? So growth is still important. You would prefer a company which is 50% growth and minus 10 EBITDA margin to a company that is 40% growth and break even. However, this also informs our views on valuation, right? So we basically look at where this company is. We want companies that are rule of 40 or thereabout. And then, looking at the sector, understanding their rule of 2x, we essentially try to price off that.
Okay. So it's not about price discovery, but it's really about fixed requirements. We've got 4 minutes left, Michael. We're going to look back and look ahead. So looking back in 90 seconds, what do you think is the best decision you've made over the past few years? Is there a single decision as a GP that you made?
when the terrible events of October 7 unfolded in Israel, we made a very conscious decision to double down. And this was both an emotional decision, but also a business decision. We actually thought that, the country will be strong, that the people will be strong, and that the tech scene will continue to essentially be what it is. They call themselves the startup nation, and they do it for a good reason. And the stock market has been up 93%, notwithstanding what happened. The depth of tech talent and sort of the amazing success that they had has not stopped. However, valuations did go down because obviously of what's happening in the world. Of course, a lot of players in the world, especially players related to Western governments, they now have to act differently than before. And so this meant that there is less money in that market, valuations have come down, and the opportunity hasn't changed at all. So to me, Israel has been in the past 2 years and remains a huge buying opportunity. We've doubled down, and it's been an excellent decision. We're very happy with it.
And we're seeing tremendous activity and success, of course, in Baltic states as well. So again, going back to sort of people capital and bringing the right people to play. That's an expertise, an area of strength for you. Final question: what growth strategy or business model do you think will be the most viable for startups in the next 2 to 3 years? It's a very broad question, but is there any particular angle or approach that you think would resonate the most in these markets?
I'm not going to be original. I'll go back to the phrase that I've already mentioned, that AI is eating the world. I think that businesses have to embrace new technologies, and even existing businesses have to embrace new technologies within their GTM, within their go-to-market strategy, right? It used to be simple. You either have direct sales, inbound, outbound, and then you have some partnership sales, right? But now there's so much technology that you can actually use to make these channels efficient. So I see a world where, it's going to be my AI talking to your AI, essentially, agreeing transactions, right? And I just have to sign off, or maybe not even that. So I think that what we will see is that the market will essentially brandish companies either as AI winners or AI losers. Yeah. And I think it's very important for companies to get ahead of the game and sort of make sure that the market views them as AI winners. And certainly already today, it is possible to use tools, AI agents and all kinds of tools in your go-to-market strategy to make whatever go-to-market you do more efficient.
So final question. Is AI then the great democratizer? Is it possible with a good idea to go to market at significantly less cost if you're a founder?
Yes, there is now less cost involved also in developing product, right? But just maybe also to show a little bit the other side of the coin as a final thought, AI still has its issues, and the primary issue being hallucinations. So AI is perfect if you need something that looks very good but is not 100% accurate, right? So for example, if you want to learn a language, great, AI can do a great job, right? Because even if you're learning with a human teacher and he makes a mistake, okay, you're just a student. You have no idea if what he said is perfect or not, right? And you don't really care. You just need him to talk well enough for you to be able to learn from him, right? But then there are other areas, and I'll mention just two, like, your tax return. It needs to be accurate. It can't be 90% accurate, right? It needs to be accurate. Or like flying a plane. You want to make sure that, it's accurate because human lives are, there in the balance. So I think that there is still significant development that needs to happen in AI before it can be applied to problems where we need 100% accuracy. But wherever 90 or 80% accuracy is enough, I think AI will do a great job.
Well, crossing fingers. Look, we're in an amazing age, and funds like Flashpoint are facilitating discovery and change, all for good.
That's our dream. Thank you.